Hey guys, and welcome to part 2. In today's videos we're going to keep going about the 8 different investment categories that I invest in. So today we're just going to keep going where we left off, and let's dive into it. Number 3 is stocks. If we look at what the definition is of a stock, it says a stock is a security that represents the ownership of a fraction of a company. So a stock is a company, like for example Apple. If you want to be partly owner of Apple, you can buy the Apple stock. And units of a stock are called shares. So for example, if you want to buy Apple, you can buy 5 shares and you become the owner for a part of Apple. A very small part in this case, but you will be partially owner. And a lot of people just look at the stock price. But the stock price itself doesn't tell you the full story. Because let's look at this example. For example, the stock price of Netflix is more or less around $550 per share. And if we look at Coca-Cola, the share price is around $50. So can we then say that Netflix is worth 11 times more than Coca-Cola? No, that's not how it works. And it's funny because both companies are worth around the same. But how come that Netflix has a stock price that is 11 times higher than Coca-Cola? Well, the answer is kind of simple. There are much more shares available of Coca-Cola than of Netflix. And like I said, the stock price by itself doesn't tell you the full story. So to get a better understanding of how much a company is worth, we look at the market capitalization or market cap. To calculate the market cap, you need to know 2 things. The current stock price and the amount of outstanding shares. So an example is Apple stock, the most valuable company in the world. The number of outstanding shares of Apple is 16.79 billion and the stock price is around $135 per share. So to calculate this, we just have to multiply those numbers and you will have this crazy amount of $2,265 billion. It's the highest valued stock listed company in the world. And these are just some of the metrics that you can use when you look at a stock and the value of a company. So in general, there's 2 different ways that you can earn with investing in stocks. The first one is when the stock price goes up. So for example, you buy a certain stock for 100 euros per share and then later on you sell that share for 110 euros. So then your profit is 10 euros per share. The other way is through dividends. And dividends are when a company decides to share their profit with their shareholders. And mostly only really big companies do this because smaller or scale-up companies reinvest all their profits into expanding. And in the future, I will make a video about the difference between dividend stocks and growth stocks. Investing in stocks can be quite profitable. Let's say you invested in the company Amazon when they IPO'd in 1997 and you would have invested 1,000 euros. Your 1,000 euro investment would be worth more than 1.5 million euros today. That's a profit of more than 150,000%. But of course, who would have known that Amazon would have become so big back in 1997? But on the other hand, investing in individual stocks can also be very risky. For example, if a company goes bankrupt or if they get caught doing something really, really bad. And an example of that was last year with Wirecard. I don't know if you heard about it, but it was all in the news. And what happened was that they basically lied about their assets. On their balance sheet, there was 1.9 billion euros that the accountants couldn't find. It was missing, so to say. But what happened was that they just lied about it and they made their financials look very good when it actually was very bad. And you can maybe imagine what happened with the stock price. That's a decline of 99.7%. So if you would have invested 1,000 euros at the peak of Wirecard's stock price, right now you would be left with only 3 euros. So there it shows how risky it can be to invest all your money in one stock. And that's why most of the people, and I also recommend, that you spread your investments throughout at least 5 to 10 stocks. Another advice I would want to give you is that you find stocks in different sectors, so that you not only buy companies that are in the IT or are only in the finance. Because if that sector hits hard, you lose a lot of your money. But if you are spread out through different sectors, if one sector goes bad, the other sectors can make up for it. So you more or less manage your risk in that way. Number 4, ETFs or exchange traded funds. ETFs are a really nice investment category if you don't want to invest too much of your time in checking all the financials and fundamentals of the individual stocks. There are many different ETFs out there, but where it basically comes down to is that an ETF is a basket of different stocks. The average return of ETFs lie between 4 to 9% per year. What is an example of an ETF? Well, let's take the S&P 500. The S&P 500 contains the 500 biggest stock listed companies in America. If you buy S&P 500 ETF, that means that you buy a small portion of each of those 500 different companies. And the thing is that you don't have to buy them one by one. No, you just buy one thing and you are invested in all of the 500 companies. So it's really easy to do, and you also really minimize your risk because you are spread throughout all of the different sectors. Think about IT, finance, healthcare, aviation, fast consumer goods. So like I said, there's many different ETFs out there, and there's also many different brokers. So how do you select which broker and which ETF you want to buy? Well, a big thing to look out for with buying ETFs is the maintenance cost that they charge you. Because ETFs are a really passive way of investing. They don't charge you a lot of fees, but one of the fees they charge you is the maintenance cost. And that basically means that you pay the broker a small amount per year for offering you the service of buying ETFs. And here, a small difference in the percentage that they charge you can make a huge difference over time. Here, a quick example. Let's say you invest for 30 years, 100 euros per month, and you have the average return of 7% per year. So then you have broker A, who charges you 1% maintenance cost per year, and broker B charges you 0.5% per year. While this doesn't sound like a lot, after 30 years, the difference between the two is pretty big. The total amount that you would have with broker A is 94,870 euros. And the amount that you would have with broker B would be 103,650 euros. So that's a difference of 8,780 euros, or 9.25%. Here you can see how a small percentage really makes a huge difference over time. So if you like my video so far, I would like to ask you to smash that like button. And if you want to learn more about investing or personal finance, please subscribe to my channel and click that notification bell so you won't miss out any of my new videos. Number 5, cryptocurrency. I think everybody heard about cryptocurrency. And when you say cryptocurrency, most people think about Bitcoin. And that's not so weird, because of the total value of all 8,480 cryptocurrency, 61% is Bitcoin. And you heard this probably as well, but lately the price of Bitcoin just went up and up and up. It is now almost $50,000 per one Bitcoin. That's crazy. And many believe that the price can even go up to $500,000 per Bitcoin. So if that's true, then there's still a lot of money to be made with investing in Bitcoin. But investing in cryptocurrency is highly speculative, and it's not been used a lot yet. Maybe it will be in the future, but who knows? And although it can be quite profitable, you can also lose a lot of money in a really short period of time. It isn't uncommon that it goes down 20-30% in just one day. So I think this investment category is very interesting, but also very risky. And I would advise that you don't use more than 5% of your total portfolio with investing in cryptocurrency. And what is cryptocurrency anyways? Well, it's really hard to explain, but I will try to explain a little bit about it. What it basically comes down to is that it's a currency and there is no physical thing for it. So, for example, with the euro or the dollar, you have bills, you have coins, but with cryptocurrency, it's fully digital. Actually, it's just a random sequence of numbers and letters combined. And many critics say, like, how can it have any value if there is nothing physical representing the value of Bitcoin? But in many ways, it's very the same with our currency right now. For example, the dollar or the euro. I mean, for example, if you look at a 500 euro note, the production cost of that note is around 20 cents, but the value it represents is 500 euros. So there's a big difference there. And it only has that value because you and I and everyone decided that that specific note is worth that amount of money. And for most part, all of our currency is digitally anyways. There are some different estimations about this, but the most say that around 92% of all our currency is digitally. So that means that only 8% is physically, like notes or coins. So the big difference between normal currency and cryptocurrency is that most cryptocurrency are decentralized. So that means that there is no one or no organization who decides how many there is, how they are distributed, or who keeps an eye on if there is no fraud going on. And in a decentralized system like Bitcoin, the users are the ones who own this and who make it work. So then you say, why don't just copy a Bitcoin if it's just digitally? But that's not possible. And the way it works is that all the Bitcoin transactions are being recorded in a big ledger, and that's maintained by 1 million Bitcoin miners throughout the world who constantly are checking which transactions are valid and which not, and they constantly communicate with each other. So in that way they can make sure that the Bitcoin transactions are really happening and it's really true. And in that way you don't need a third party to verify that my transfer to your Bitcoin account will happen, because that's what all those miners do. So yeah, this is just a really brief explanation, and if you want to know more about it, I have an interesting video that explains how it works. I'll leave a link in the description so you can check it out. So that wraps it up for part 2 of my mini-series, the 8 different investment types that I invest in. And I hope I see you in the next one.